April 6, 2025. The world is reacting to sweeping new U.S. tariffs that have sent shockwaves through the global trade system. This presentation explores how America's trading partners view these developments, not from Washington, but from Beijing, Brussels, Tokyo, Hanoi, and beyond. What do these tariffs mean for the global economy, for supply chains, and for the rules of trade? And how are nations positioning themselves in response? Let's begin. The U.S. has implemented a baseline 10% tariff on all imports, with additional country-specific surcharges that raise the total to as much as 54% for some countries. These tariffs are being applied without multilateral negotiation, bypassing the WTO framework that has governed global trade since the 1990s. For many countries, the abruptness and scale of these measures are deeply concerning. They are seen not only as protectionist, but as a direct challenge to global trade norms and long-standing relationships. The global response was swift. China retaliated with new export controls on rare earth materials. The European Union issued a formal condemnation and signaled a legal challenge via the WTO. Japan and Vietnam expressed diplomatic concerns, emphasizing the disruption to existing trade agreements. Meanwhile, financial markets reacted with sharp volatility, reflecting investor anxiety over potential escalation and long-term fragmentation of trade flows. These tariffs have disrupted sourcing patterns across Asia, Europe, and Latin America. Many companies that rely on cross-border supply chains are now facing higher costs and re-evaluating their logistics strategies. In response, businesses are accelerating diversification, shifting operations to Mexico, India, and Southeast Asia to bypass tariff zones. What was once a finely tuned global network is being restructured, potentially for good. China has imposed mirror tariffs on American imports, targeting agriculture and technology. The EU is reviewing selective countermeasures, including tariffs on U.S. digital services and food exports. There are increasing calls for the expansion of BRICS Plus and the development of regional trade blocs that exclude the U.S., from formal retaliation to informal alignment. Trading partners are exploring a full spectrum of responses. For exporters, this is a moment of reckoning. Countries that depend on the U.S. as a primary market are now seeing orders decline, margins tighten, and competitiveness erode. In response, governments may have to offer subsidies or economic stimulus to keep key industries afloat. There are also renewed accusations of currency manipulation as countries attempt to offset U.S. tariffs through exchange rate adjustments. Many U.S. partners believe these tariffs violate WTO principles, especially those relating to non-discrimination and fair treatment. The use of a unilateral formula to determine tariff rates is seen as arbitrary and punitive. Legal teams across Europe and Asia are examining how best to challenge these measures while preserving broader diplomatic ties. The tension is not just legal, it's also strategic, as nations weigh confrontation versus containment. The 2018 to 2020 trade war between the US and China is instructive. Tariffs caused significant economic pain on both sides, yet they did not lead to full decoupling. Instead, trade was rerouted, and China deepened its ties with other economies. The same pattern may repeat now. While some supply chains may shift, the core economic interdependencies will persist. What changes is how trade is framed, as an instrument of influence, not just exchange. The broader concern is inflation. Tariffs raise the cost of inputs, which filters through to higher consumer prices. At a time when many economies are already battling post-pandemic inflation, this adds fuel to the fire. Global demand may soften as purchasing power declines. And if protectionism spreads, the risk of a fractured global economy, with higher costs and lower growth, becomes very real. Countries are adapting fast. There is a surge in regional trade negotiations, particularly those that exclude the U.S. Countries like India, Indonesia, and Brazil are emerging as key players in this evolving landscape. Multinational corporations are investing in supply chain localization and dual sourcing strategies. Diplomatically, nations are rethinking their alliances, not just for trade, but for technology, infrastructure, and defense. What many nations are now calling for is a return to coordinated trade policy. A new global summit or WTO reform round could provide an outlet for these tensions. Without such coordination, retaliatory cycles may deepen, and the post-WWS trade architecture could fracture. Countries agree. Tariffs should be a last resort, not the first strike. The question is whether anyone still has the influence to bring all sides to the table. There is also a deeper macroeconomic question. The US dollar is the world's reserve currency, and for that role to continue, dollars need to circulate globally. The US trade deficit plays a key role in this by pumping dollars into the system. If tariffs succeed in reducing that deficit, it could unintentionally undermine dollar liquidity, with ripple effects for global finance. In this way, the tariffs may undercut one of the pillars of US economic dominance. Different countries are taking different paths. China is pursuing an assertive response, retaliation, parallel institutions, and new trade routes. The EU is focused on legal challenges and regulatory counterbalances. Japan is leaning on diplomacy, hoping to soften the policy without confrontation. Vietnam and others are hedging, seeking new trade partners while avoiding direct conflict. The world is not united in opposition, but it is actively reassessing its options.